What's up, future CPAs? Welcome to a 5-minute power-up session on asset management ratios. Look, this isn't about last-minute cramming. This is about building real knowledge that's actually going to stick with you all the way to the LEBPA and beyond. So here's our game plan for today. We're going to move way past just memorizing formulas. The goal here is to truly understand how a company's operations really tick. Let's get right into it. All right, first things first, let's talk about the biggest challenge, right? There's a huge difference between cramming for a quiz tomorrow and building the deep, lasting knowledge you need for the big one, the licensure examination for certified public accountants, the LCPA. So I gotta ask you, which is it gonna be? Are you here to just survive by memorizing a bunch of stuff? Or are you here to thrive by actually understanding it? Yeah, this session is all about thriving. We're gonna turn these abstract formulas into some seriously powerful tools you can actually use. Okay, so how do we actually measure all this stuff? Well, we use a set of tools called asset management ratios. The best way to think of them, it's like a scorecard for how fast and how efficient a company is. Now, they have official names like activity ratios or efficiency ratios, but I want you to think of them as the company's speedometer. Seriously. They tell you exactly how fast a business is churning through its assets, inventory, equipment, all that good stuff to actually make sales. It's all about speed. And these ratios, they paint a super clear picture. Is the company basically a rocket ship turning its assets into cold, hard cash at lightning speed? Or is it more like a snail, with inventory just sitting there collecting dust while it waits and waits for customers to finally pay up? All right, let's open up the toolkit. We've got 3 main speed dials that we're going to look at to measure this efficiency: accounts receivable, inventory, and total assets. First up is accounts receivable turnover. So in plain English, this just answers one simple question. How fast is the company collecting the money it's owed by customers who bought stuff on credit? And the math behind it is pretty straightforward. You just take your net credit sales and divide by your average accounts receivable. This gives you a number that tells you how many times per year the company collects all its outstanding cash. Every number tells a story. A high turnover, that's generally good. It means cash is coming in the door fast. But, and this is a big but, if it's too high, it could mean your credit policy is so crazy strict that you're actually scaring away good customers. It's all about finding that perfect balance. Okay, next up, let's move from the sales desk over to the warehouse. Inventory turnover tells us how quickly products are flying off the shelves and getting restocked. So for this one, we divide the cost of goods sold by our average inventory. A bigger number here means your products are moving way more often. And just like with receivables, there's a trade-off here too. High inventory turnover is awesome. It means you're not tying up a bunch of cash in products that are just sitting there. But if it gets ridiculously high, you risk stockouts. I'm talking empty shelves. And that just means lost sales and some pretty unhappy customers. Efficiency is the goal, but not if it costs you sales. And now, let's zoom all the way out to the big picture. Total asset turnover. This is like the ultimate efficiency ratio. It asks, for every single dollar the company has invested in assets, buildings, machines, you name it, how many dollars in sales does that $1 actually bring in? The calculation is as simple as it gets. Sales divided by average total assets. This is basically management's final report card. It shows if all those massive investments they made are actually making the cash register ring. Okay, so now it's time to connect the dots. You see, these ratios don't just exist on their own in some vacuum. They all work together to tell the complete story of a company's cash flow. And we measure that story with something called the cash conversion cycle. This is the master timeline. It's so important. So we take the number of days it takes to sell our inventory, and we add the number of days it takes to collect the cash from those sales. Together, that's our operating cycle. Then, and this is the genius part, we subtract the number of days our suppliers give us to pay them. The number that's left over, that's the cash conversion cycle. That's the time gap that we have to fund with our own money. For any financial manager out there, the goal is dead simple. Make that cycle shorter. Every single day you can shave off that time frees up cash that you can use for growth, for new investments, or just to pay down debt. Now, get this. Some companies are so unbelievably efficient, they have a negative cash cycle. Dell is the famous example. They had a cycle of negative 42 days. Think about that. That means they got paid by their customers a month and a half before they even had to pay their own suppliers. It's absolutely a masterclass in efficiency.
Okay, we have flown through these concepts. Now for what I think is the most important part. Let's make sure all this information is locked and loaded in your brain for the long haul, like all the way to your LECPA exam date.
All right, time for a rapid fire review. Seriously, screenshot this slide, write it on a sticky note, and put it on your monitor. Burn it into your brain. This is the absolute core framework for everything we just talked about. And if you remember one thing, remember this hack. I want you to picture a stopwatch. That watch starts ticking the exact second that cash leaves your bank account to pay for supplies. And it only stops when cash from a customer comes back in. Your entire job in asset management is to make the time on that watch shorter. So I'll leave you with this one last thought to really apply what we've learned today. Think about a fast fashion brand like Zara. Which one of these cycles do you think is the absolute most critical to their success? Chew on that, because that's what makes this stuff matter in the real world. Thanks for tuning in, and I'll catch you in the next explainer.